I strongly suspect that the phone calls between the major banks and the Fed have been increasing at a tremendous rate over the last week or so. Because it's not just one bank, it's all of them. They're going down much harder than the stock market.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for March 31st through April 7th, 2025, while supplies last. First this week, we feature 1 ounce Gold Britannia at just $59 over spot. Next, Silver Britannia are only $2.99 over spot. 1 10th ounce Platinum Britannia are just $29 over melt. And 1 10th ounce Gold Britannia are only $27 over melt. All of our specials this week are IRA eligible. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis. OliverMSA.com. Michael, thank you so much for joining us today.
Good to be back, Elijah.
Well, it's great to have you, especially on this wild ride of a market, or really all markets are going crazy today as we record this on Friday. Gold and silver are down. The stock market is plummeting. What do you make of what's happening?
Well, we've been waiting for the stock market to top because the technicals have told us this is the biggest bubble in stock market history that ended early this year. From 2009 to then, 15 years of massive multiple upside caused by monetary policies. We know QEs lasted for, we had free money for 10 or 15 years. And even when they raised rates, it was lower than it had been in 50 years. So, it was free money. Okay. When you have free money, it goes somewhere. And it went into the stock market. Investors now are deciding maybe they don't want it there. Okay. And yes, the guys who claim, and there's many of them, and analysts and investors, that when the stock market goes down, so does gold. They're too much focused on a narrow event in a brief period of time. The last time of where this occurred, and they still remember it, is that October of 2008. At that point in time, gold had already been rising since its lows in price. In the year 2000, 2001, it was about $260. It went up all the way to 1,000, okay, quadrupled. And that was before that collapse in the stock market. And in fact, part of that was while the stock market had already topped and was headed down. The stock market had been dropping for a full year, and gold still rising. But in the summer, especially in October of 2008, the stock market finally had a sharp drop within the context of what was already an ongoing bear market. It dropped like 30% in a month, okay, October of 2008, a year off the high. At that point, gold said, I'm going to correct too. I'll use this as a correction opportunity. And it had a collapse down into the 600s. And people think it goes with the stock market. Gold is a monetary metal. It is the inversion of the ongoing collapse in the real value of paper money units. Yens, euros, dollars, you name it. They always depreciate because governments always expand the money supply. They create free money, artificially low price of credit, and it creates distortions. And gold is merely an ongoing reflection of the decay in the monetary units that we use. That's still going on now. Money supply is still growing. It basically doubles almost every decade. And when the Fed has an excuse or justification, which is what they were created for, to save certain institutions, banks especially, they push the pedal to the floor. Okay, and sometimes they back off a little bit, but then they push it to the floor again. Now, if you saw Powell today, he was comfortably smiling and talking about, we have these two mandates and the economy looks solid. Even the reporters in the audience were smart enough to say, yeah, but when the stock market goes down, then the data points change. It's a point we've been making for many months. They don't turn first and then, the economy's getting worse, so the stock market goes down. No, the Fed is going to have soon all the data points they need to smack them in the face to, again, push the pedal to the floor. And I know they don't want to because, frankly, they don't like Trump. He doesn't like them. So there's an antagonism there. And so Powell's kind of smiling right now because stock market's going down and he's not getting blamed for it by keeping rates too high for too long. Trump is getting blamed for it. So he's in perfect position. The problem is this, the banks. And look at an ETF like KBE, which is the major bank ETF. Look at Bank of America. Look at Citicorp. I mean, these banks are dropping enormously, far more than the S&P. In fact, over the last week, S&P be down 3 or 4% one day, 3 or 4 the next. Banks would be down 6 or 8%, 10%, et cetera. And I'm not just talking 1 or 2, but the sector. Okay, that is a sector that few people are talking about for some reason, and that's the one that will provoke the Fed into panic mode, and probably not even waiting for a meeting. So I think that's where we stand right now, and I think that is an underlying explosive ingredient for gold. And for silver. And we can comment on that a little bit later if you want to talk about silver.
Well, I would like to get into that because your premise for a long time has been that when we see a stock market crash, a lot of the money will move into precious metals. So it seems like right now we're seeing both fall at the same time, but you're seeing maybe that reversal happening pretty soon.
Well, if you look at the mama market, gold, right now as we speak, it's trading 3.5%, okay, off of its high daily close, which occurred a week ago. But it's down 3.5%, okay. Stock market was, look at bank sector, stock market, and silver and commodities also going down because we're going into a depression or something. Well, we might be, frankly, but there's a couple mistakes there. One is the assumption gold goes down with the stock market. Yeah, it could go down on a couple weeks here and there with the stock market in a sharp situation. But let's go back and look, for example, at that October of 2008 event. That's when the stock market had already been coming down hard for a full year and finally had a puke. Okay, and gold said, oh, okay, I need to correct anyway, so it had a puke. The Fed sat and watched the banking sector implode during the summer. I mean, the Lehman Brothers went under in September of 2008. Stock market collapsed the next month in October. And it wasn't until November that the Fed finally said, okay, we got to do something. They'd been cutting rates all the way down, but they did QE at that point. So right after that October collapse, a full month or two after Lehman went under, the Fed finally woke up, copied the Japanese model, and started doing QEs. November 2008. Stock market, by the way, went down for 5 more months into March of 2009, substantially further lower. But if you bought early in November, right after that October debacle, where you thought, oh, stock's going down, therefore gold goes down, actually, gold stopped and turned and started to explode back to its highs within about 3 or 4 months, had gained from the 600s back to 1,000, like a 50% gain. Not because the stock market turned up, no, because the Fed hit the pedal. And that's what causes gold to move the way it does. Now, right now, if you look at Powell today, they're not going to hit the pedal. He's just going to be academic about it and wait for the data points. I mean, when the blood's in the street, he'll finally see the data points. I strongly suspect that the phone calls between the major banks and the Fed have been increasing at a tremendous rate over the last week or so. Because it's not just one bank, it's all of them. They're going down much harder than the stock market. So everybody's talking about, oh, well, Tesla collapsed and Nvidia's down hard. Who cares? It's the banks that matter to the Fed. After all, the Fed is the banks, okay? Now, that's why gold's down 3.5%. Somebody's buying gold relative to the rest of the world. And I think that's because they see what's coming. The Fed has maybe learned a lesson since 2008 and learned, hey, we can't wait too long. We can't wait for an actual big bank to go under because then we'll look like idiots. We need to actually do a QE, start buying assets, start buying banking ETFs or whatever, bank stocks or commercial real estate's another implosion area, before it becomes a bloody headline. And I think gold knows that. It knows maybe the Fed's a little smarter now and will implement their aggressive policies real soon. Watch the bank sector. That's the key. Now, the case is silver. Investors are making a big mistake there. Okay, if we're going into a major global recession, maybe a depression, wouldn't surprise me, given the bubble size of the U.S. stock market, the Japanese market, and the Indian market. They're all imploding together. Industrial commodities will go down. Now, they don't necessarily have to stay down because when the Fed puts the pedal to the floor again, that money goes somewhere and commodities are still dirt cheap and we think they're going to go up. But right now they're going down with the stock market. Industrial commodities, crude oil, copper. Okay, they're treating silver not like gold. Like I said, down 3%. Silver's dropped from $35 to $29 almost in a matter of a week or so. It's behaving like copper and oil. Somebody's making the conceptual error that silver's an industrial commodity, not a monetary metal. So just fundamentally, now there's technical reasons for what I'm saying. Just fundamentally, if I were an investor wanting to put my money in monetary metals, knowing that the Fed's going to panic here, probably sooner than they did in 2008, that I want to own monetary metals because paper money is going to be far worth less than it might otherwise be because they'll accelerate the growth in the money supply. I'd look around and I'd say, well, gold's behaving well. Yeah, I'd want to be in gold, but that silver's ridiculous. It's a slingshot situation. It is not copper. It is not crude oil. Okay? It's a monetary metal. And right now, for the last week, investors have forgotten that. And they often make mistakes. Investment crowd often makes excessive mistakes either way. So right now, I'd say we see this pullback in gold and silver as a major buying opportunity. We're looking for the least excuse to define the upturn. And I strongly suspect it won't really take a full 30% crash in the stock market to do that. I think you got to watch the banking sector. If it doesn't behave well real soon, and already it's done so much damage, I don't think it will, the Fed will panic. And that's the name of the game.
Now, with respect to gold versus silver here, we see silver about 1% of gold's price. So 100 to 1 ratio of gold silver, which is almost unheard of. We saw once during the COVID crash, it spiked above that, but I don't think we've ever seen this in history before. So what is your perspective on that? And I guess maybe that trade of gold for silver at the moment.
Yeah, the silver gold spread has been trying to break out, as has the gold miners versus gold. Which when you plot the spread chart, and we do it like weekly in our reports, there's certain levels. If you can get GDX up to a certain level versus gold, it's going to break up a couple year downtrend on the spread and say, okay, I'm back. Okay. Silver has a similar situation. And you're right. We're literally in the gutter historically in terms of price. So either we're totally wrong and silver is no longer a monetary metal, which I don't think is the case. And by the way, if you go back, for example, over the last year, for let's say March of 2024 to the close of last month, silver went up, the commodity index went up a slight amount, I think, during that year, a couple percent. Silver went up almost as much as gold on a percentage basis over that 12-month period. So silver was moving with the monetary metal, not with crude oil, which is laying on a floor for the last year, or copper. It was behaving like gold. And suddenly for this week, it's not behaving like gold. I think that's a mistake. Silver is the little puppy on a leash held by gold, okay? And I think right now it is in a slingshot position. Yes, there may be slightly lower lows next week, but I'd be watching right now for any sign of an upturn. There's another reason, technically. I used to keep point and figure charts. People, the X's and O's, where you get upticks, you get downticks. Silver never tops with a double top. Well, we made a high at 35 back in October. We had a drop down to 30. So you had 4 downticks on a $1 chart. Then you went back up to what? 35 last month and this month. You put the upticks back on the board to 35. So you peaked at the same level you did last October. And now you've downticked again to 30. Almost traded 29 today. I actually want to see it trade to 29 and take out that last low. So people then pull their hair out. So, oh my gosh, it's no good. Because on a point and figure, when you do that, you set up a double top and take out the column low. Pardon me if I'm being academic here. And then you start to uptick. What it was a bear trap low, meaning you went down and took out the last low to spook people. And if you don't sustain and you start to uptick, you're headed for a triple top breakout. And I think that's what silver's setting up here, is a compression situation where it flushes everybody out without the help of gold. I mean, like gold's only dropped 3.5% and suddenly turns and burns. And so I think watch gold. I don't think it's going to do what the stock market's doing or what silver's already done or what commodities have done. It's hanging in there pretty tough. And I think that says something. And I would focus on the banks because we know that that's the arena that will cause the Fed to not openly and publicly, but to quietly, behind the scenes, panic. And probably even have a cut or QE instituted even before the next meeting.
Now, when it comes to the banks, as you mentioned, it sounds like that they're in trouble. Do you think this is for the whole banking sector or just some of the major banks here?
It could be, obviously, it could be one or two or three here or there, but I'll just look at all of them, and they're all behaving very much the same. The only difference is some of them are down a little more than the others. Bank of America and Citicorp have dropped more than, let's say, JP Morgan or a few others, but they're all down hard. And the point is, it's not that they've been going down for a long time and therefore might be near the end of a decline. By our metrics, the decline just commenced. Technically speaking, on quarterly momentum. It just broke late last month, early this month. So the game is just on. And they have a long way to go, and they're doing a lot of damage. And I can see some of the price charts that people are looking at saying, well, let's try to buy it here. It's ripping through prior pivotal lows freshly. So even the price guys should start to get concerned here. But I think that's the area that, again, it's not a headline. For some reason, they're still focused on the Mag 7, but it's the banks that are the one that really count. And the other sector that is very dangerous is commercial real estate. We've been pounding the table about that for quite a while. Not mortgage real estate, but commercial real estate, because that's a debt crisis arena. And there's a couple of ETFs on that, RWR and VNQ, that you can look at. And they own the big companies that own the shopping centers and the commercial centers and the computer centers and all kinds of things like that look like hell, technically. And they have a lot of debt. And we know that that could be an arena that impacts the banks if you start to have problems there. And so don't be surprised in the next month or so, you start to see some, oh my gosh, a headline out of the financial arena. And that's when the panic really sets, because when the public starts to hear that stuff, NVIDIA going down is one thing, but when you start to have banking problems, the Fed will panic and will the public. So I think we're near that point. So what I'm looking for is the stock market drop to actually explode gold, especially the banking sector, because that's when the Fed puts the pedal to the floor, and we're back in November of 2008. Forget the October drop. It's the November action by the Fed that took gold right off the page and went from 600 and something up to over almost 2,000 over the next couple of years. Despite the stock market continuing down for 2 more quarters, gold was back to its highs. So I think we're in that kind of situation right now.
Now, with respect to gold and silver, again, we've seen for the last couple months, outflows from the LBMA. Largely, as people say, that might be because of fear of Trump tariffs. So now that Trump has, confirmed that tariffs are coming, do you see that flow continuing from the LBMA over to the U.S.? I'm
not sure about that situation. I don't pay much attention to it because it's one of those that's transient. Yes, it's a big issue right now, and it probably does reflect incredible demand for the physical stuff. And that's interesting in itself because owning the physical stuff instead of the paper version of the physical stuff indicates concern. If you want to put it another way, panic. I want to hold the real stuff, okay? Not a piece of paper that's contingent upon certain things not occurring, okay? So that could be an underlying statement of what's going on out there in terms of sentiment among large acquirers of gold. And right now, the public is really not, the American public in particular, is not gotten behind the gold bandwagon. They'd missed a tripling in the price of gold over the last 15 years because they've been focused on the stock market. Now that bubble's starting to break. The question is, well, will gold go down with the stock market? Yes, in a brief period it might. Well, for some reason this past week, which has been disastrous for stocks, gold didn't go down 3%, if you want to call that down. So I think that the money flow is moving. And I think the silver situation is very unique because there's a mistake being made. One, it does move with gold ultimately. It does not move with commodities generally. Their historical correlation is not good. Its correlation with gold is very good. Right now, it's in a slingshot underperformance situation to gold, but I think it's a great mistake, which will snap back quickly. So when gold does start to outperform, my bet is it doesn't crawl back. It does something fairly explosive in terms of net price gain. So we're still quite bullish on the monetary metals, and we think this is a bear trap situation, especially for silver. And don't pay attention to the commodities in relation to silver. Pay attention to gold.
One last question with respect to the miners. Obviously, we're seeing a sell-off in the miners as well. Along with this, do you see that this could be related to maybe money managers moving into the space, or do you see this just kind of people are selling because of margin calls?
Probably the latter. We do know that leverage in the U.S. stock market is like triple its norms, okay? Triple any prior time. I've seen studies on it. I don't pay that close of attention, but that's an interesting fact. And therefore, this drop, which is now maybe getting to the point of creating margin situations, but we do see a bounce point in the S&P, a potential bounce point. And it better well bounce from there. But that's down another, like we're trading near 5,100 today. The S&P looks like it might have a bounce point at 4,800. The NASDAQ 100 is trading in 17,500 area. It might have a bounce point in the 16,000 area. So a good handful of percentage drop, 6, 7, 8%, and you'll get to a possible bounce point. Not a low, but it could. But that's still not a crash dimension, actually. You know, if you think about 30% drop is a crash in a matter of a couple of weeks. That's what happened in October 2008. And so far, though, we've had a sharp drop in stocks from the highs of a month ago, February, I think it was, to the present. It's still not crash dimension, and though you get a bad day here and there, there's not like a 30% drop. Who knows, maybe we'll get it. Now, if S&P ever violates 4,800 substantially and closes a month out, like, much under 4670, let's say, I'll give you a number. At that point, you're blowing some other momentum structures that say all hell could break loose. But right now, we tend to think you could have a bounce point around the 4,800. Now, that might get relief to the commodities and silver might bounce. But right now, I'd be focused on gold and silver as basically the only place to really be when the central banks panic, realizing what is actually going on, especially with financial institutions.
So last thoughts then for our viewers. It seems like the broad overview might be that this shift that you've been talking for a long time of people moving from stocks into gold is showing strength, only down 3% when the stock market is down quite a bit more. So is that shift happening right now?
I think it's been happening ongoing for the last several months, where early money has been moving out of an asset category they deemed to be too high risk, too low reward. Even though it hadn't dropped at that point, January, February, the money was starting to move. That's why miners, for example, shot up substantially over the last several months. In fact, XAU index and GDX, the ETF, if you look at the last 3 years of action since 2020, they blew that stuff out. It was a ceiling. And yeah, you pull back slightly below it, but you closed last month substantially above it. And I'm going to bet by the end of this month, you're still substantially above that range that prevailed back to 2020. So their price action has just woken up. And I think more of that money will flow into the miners, especially as the perception hits that this really is a bear market in stocks. The talk of correction is starting to get a little wobbly right now.
Certainly. And if our viewers are interested in continuing to track this with you, olivermsa.com is the place to go. Can you tell us a bit about that?
Well, we cover all four major asset categories because it's important to do so. You can't just look at gold because ultimately gold is the inverse of paper money and it is the inverse of central banks. And when the central banks panic, gold explodes. And that's what happened back in the 2008 period. It was a major buying opportunity. And the Fed lagged a bit. And this time, I don't think the Fed's going to lag so much because when they see those banks coming down, they're going to hit that pedal. And I bet they don't wait till we have a failure, another Lehman Brothers, which case I think it's right around the corner. And I think gold knows that.
Fantastic. Well, exciting times. Thank you so much for your time today here, Michael, and you have a good day and God bless.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for March 31st through April 7th, 2025, while supplies last. First this week, we feature 1-ounce Gold Britannia at just $59 over spot. Next, Silver Britannia are only $2.99 over spot. 1 10th-ounce Platinum Britannia are just $29 over melt. And 1 10th-ounce Gold Britannia are only $27 over melt. All of our specials this week are IRA eligible. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.